If you are an investor in Nvidia or Palantir, you probably saw the headlines and your stomach dropped. The man who called the 2008 housing crash, Michael Burry, has just broken a 2.5-year silence. And his message is terrifying. He's not just warning of a bubble, he's betting against it. His fund, Cyan Asset Management, has taken out a massive $912 million put position against Palantir. He's also holding an additional $186 million put against Nvidia, the world's first $5 trillion company. He's calling himself Cassandra Unchained, the prophet cursed to see the truth that no one else believes. The question for us is he right? And is the AI bubble about to burst? But here's what the headlines missed. This isn't just a bearish rampage. In the very same filing, Burry revealed new bullish positions, call options on Meta and UnitedHealth. This isn't a simple the sky is falling prediction. It's a highly selective strategic shift in his portfolio. He's not warning us about technology. He's warning us about hype and valuation. And understanding the difference is critical for your portfolio. This is a much more complex story than it appears. I'm Iggy, your Singapore-based market analyst. And my job is to cut through the noise and show you what really matters for your CPF, SRS, and SGX portfolios. And we've been putting in the work. Since October 2025, this channel has produced over 200 videos with more than 600,000 watch hours. And we were also honored to be ranked 8th in Tiger Broker's 2024 Influential Tigers. My focus is always on regional and global trends to give you that broader context so you can uncover hidden gems and potential pitfalls. Today, we are going to do exactly that with a deep dive, slide by slide, through Michael Burry's new portfolio to figure out what his moves really mean for us as Singapore and Malaysian investors. Let's start with the first slide, the case against Nvidia, the $5 trillion target. This is the big one. In October 2025, Nvidia became the world's first company to touch that threshold. To put that in perspective for us, $5 trillion is more than 10 times the entire market capitalization of our Singapore exchange, the SGX. In just 12 months, Nvidia climbed from $4 trillion to $5 trillion. The stock has jumped 50% in 2025 alone. Now, on paper, this looks absurd, but before we just dismiss it, we have to understand why valuations got this high. Nvidia is the gatekeeper to artificial intelligence hardware. Every AI model that matters, from OpenAI's GPT series to Meta's Llama, runs on Nvidia's H100 and the newer Grace Hopper chips. This company isn't just selling picks and shovels during a gold rush, it is selling the only required shovels. Revenue scales directly with AI adoption, and that is a real powerful moat. But here's where Michael Burry sees the risk, and it's the core tension in this entire story. Nvidia's fundamentals are strong, but strong and worth $5 trillion are two very different questions. Burry's view, and it's a logical one, is that Nvidia is pricing in perfection. It's pricing in decades of flawless execution, with zero setbacks, zero competition, and zero geopolitical incidents. And as we know, history suggests that is always a bad bet. Now, let's move to the second slide, which is the geopolitical risk. This is the silent killer that I believe Burry sees, but the market is cheerfully ignoring. Here's the wrinkle. Nvidia's largest growth markets include China. Chinese tech giants like Alibaba, Baidu, and Tencent are completely dependent on Nvidia chips for their own AI infrastructure. But US-China trade tensions are escalating rapidly. In October 2025, the Trump administration imposed 100% tariffs on a range of Chinese exports, and more importantly, slapped new restrictions on semiconductor exports to China. China immediately retaliated by limiting its exports of rare earth materials, which are the critical components needed for manufacturing those very semiconductors. For us as investors, this is not just noise. This is the foundation of Nvidia's supply chain and its customer base coming under pressure simultaneously. Burry liquidated his own positions in major Chinese tech firms like Alibaba and JD.com, reflecting this exact concern. He knows that if US-China tensions worsen, Nvidia's growth in its second largest market could stall overnight. Even worse, Chinese competitors, backed by massive government subsidies, are in a desperate race to achieve semiconductor self-sufficiency. In the long run, that is an existential threat to Nvidia's moat. For us in Singapore, this is not a distant threat. Our own economy thrives on regional stability. We are a key node in the semiconductor supply chain. You just have to look at our own SGX-listed names like AEM Holdings or UMS Holdings. A disruption to TSMC in Taiwan, whether from trade policy or military action, would be felt directly in our own market. This isn't a maybe risk, it's a when risk, and it is not being priced in at all. This brings us to our third slide, Palantir. This is where Burry's bearishness gets even more pronounced. Palantir Technology saw a much more dramatic move than even Nvidia, soaring 174% in 2025. In response, Burry took a massive $912 million put position. That is a bet nearly 5 times larger than his one against Nvidia. What does this tell us? It suggests Burry sees far more immediate, hype-driven, nonsensical downside in Palantir than even in the $5 trillion giant. Why? We just have to look at the valuation. Palantir trades almost entirely on promise, not on current profitability. Now let's be clear. The company specializes in data analytics and AI software for government and enterprise clients. Its products like Gotham and Foundry are valuable. Its moat with government agencies is real. But the stock has already priced in decades of flawless exponential growth. Burry's worry here is simple. Palantir is a quality company at an insane price. I use this analogy often. It's the difference between buying a good house and overpaying by 300%. Yes, it's a good house. You have a solid asset, but paying $3 million for a $1 million home is still a bad investment. The asset quality doesn't save you from a bad entry price. When growth expectations reset, even slightly, the downside for a stock price this high is absolutely brutal. But as I said, this isn't a simple sell everything story. Let's look at slide 4. Burry's selective bullishness, or where he is finding value. This is where his strategy gets really interesting for us. He's not simply going short and hiding in cash. His Q3 2025 filings also show new call options on Meta and UnitedHealth. These are bullish bets that these stocks will rise. Let's analyze this. Why Meta? Meta faced brutal headwinds from 2021 to 2024. Apple's privacy changes decimated its ad targeting. Wall Street completely abandoned it, calling the metaverse a failure. But by 2025, Meta's massive AI infrastructure investments are finally paying off. Its data center build-out is positioning it as a serious player in AI training and inference. Meanwhile, its traditional ad business is stabilizing and recovering. Burry sees a recovery story with actual earnings growth, not just AI-driven hype. And then, why UnitedHealth? This is the perfect example of his anti-bubble thesis. UnitedHealth is a stalwart, boring healthcare company. It has predictable cash flows, strong management, and a growing business, especially after acquiring Amedisys in August 2025. It is profitable, it is priced rationally, and it is completely insulated from tech hype. For a Singaporean investor, this is the exact same logic that leads us to hold our core positions in DBS, OCBC, or Singtel. They are predictable, dividend-paying cash flow machines. Burry is making a clear move. He is selling the hype and buying the boring, profitable value. Okay, so before you log into your broker and copy-paste this trade, we need our final slide. Is Burry right? This is our dose of healthy skepticism. We have to remember Burry called the 2008 housing bubble brilliantly. He was a genius. He also spent most of the decade from 2010 to 2020 mostly underperforming the market. He missed the entire bull run. Being right about when a crash happens is nearly impossible, even for the brightest minds. You can be right on the thesis but wrong on the timing and still lose all your money. Also, we must acknowledge that AI is genuinely different from the dot-com bubble. Yes, many dot-coms failed, but Google, Amazon, and a handful of others survived and went on to create trillions in value. Nvidia, despite being expensive, is generating real revenue and real profit right now. OpenAI's annual recurring revenue hit $10 billion by mid-2025. Anthropic jumped from $100 million to $4.5 billion. These are actual businesses, not vaporware like pets. The risk, and this is the key takeaway, isn't that AI is fake. The risk is that Nvidia's valuation has simply disconnected from its underlying growth rate. That's a real but very different problem. So let's pull this all together. Here's Iggy's assessment of the situation and what it means for our portfolios. First, what's working in Burry's thesis? He is correctly identifying that valuations in parts of the AI sector, particularly Nvidia and Palantir, are stretched to perfection. He is also wisely rotating into anti-bubble stocks with strong, predictable cash flows, like UnitedHealth, and recovery stories with real earnings, like Meta. Second, what's not working, or what's the real risk here? The main risk is geopolitical. The US-China trade and tech war is a genuine headwind that the market seems to be ignoring. A disruption to the semiconductor supply chain is a massive unpriced risk. Now for valuation, the problem isn't the companies, it's the price. So when a stock like Palantir is up 174% in a year, or Nvidia adds $1 trillion in market cap, you are no longer investing, you are speculating on momentum. The risk reward is heavily skewed to the downside. So here's my final recommendation, and I'm going to split this into 2 parts. First, for existing unit holders, or in this case, stockholders. If you hold Nvidia or Palantir, do not panic sell based on one man's filing. But you must ask yourself two hard questions. One, did I buy this for the long-term business or did I chase a 50% rally? And two, if this stock fell 30% tomorrow, would I buy more or would I want to exit? If you are uncertain about your answers, it is prudent to trim your position. Take some profit off the table, reduce your portfolio stress, and reallocate those funds. Second, for new buyers, and if you are looking to enter these names, wait. The risk reward just isn't there right now. Chasing momentum in mega cap tech that has already run this hard is a recipe for disaster. I would wait for a significant pullback, a 20 or 30% drop before even considering an entry. Instead, follow Burry's other move. Look for resilient businesses. For us in Singapore, that means our local banks like DBS and OCBC, which offer stable 3 to 5% yields. It means high-quality Singapore REITs offering 4-6% yields backed by real assets. It means focusing on capital preservation, not just chasing euphoria. If you found this analysis valuable and want to go deeper than the headlines, consider becoming a free or paid subscriber to my Substack newsletter, The Investing Iguana. It's where I publish all my in-depth research first. You'll be in good company. The Investing Iguana has now hit over 1.3 million reads with 65,000 likes across our platforms. We're also thrilled to welcome our growing community of over 30 YouTube Premium subscribers and 15 paid Substack members who make this in-depth independent research possible. Thanks for watching, and I'll see you in the next analysis.